Piercing line pattern. A piercing pattern is a candlestick pattern that gives us potential bullish reversal sign, and it is formed near the support levels at the end of a downtrend. Piercing pattern is formed when the bulls and bears both are fighting to gain control over the prices. This pattern is made of two candlesticks. The first one is a bearish candlestick and the second one is a bullish candlestick. The bearish candlestick should have a large real body and the open of second bullish candle should be below the low of previous candlestick and should close above the middle of the real body of the first candlestick. There is an increase in demand by the bulls and the price it starts rising, and hence you can see an uptrend. Firstly, the trend should be a downtrend as the piercing pattern is a bullish reversal pattern. Secondly, the length of the candlestick plays an important role in determining the force with which the reversal will take place. The gap down between the bearish and bullish candlestick indicates how powerful the trend reversal will be. Next, the bullish candlestick should close more than the midpoint of the previous bearish candlestick. And lastly, the bearish as well as bullish candlestick should have large real bodies. Now, how do I trade with piercing line pattern? We can plan our entry after we get confirmation that the stock is in uptrend. So, your entry point would be somewhere at the close of day 2 candle. So, you can take your position over here once you start seeing green candle getting formed, and the stop loss can be placed at the open price of the green candle in your piercing line pattern. So in case if the market does not go in your predicted direction, then you can exit your position. So that's about piercing line pattern and trading with piercing line pattern.